What's up guys, Jordan from Condo here. Today I want to talk about how a 1% difference on your mortgage rate can entirely negate a 15% decrease in rental income. As a lot of people know, mortgage rates are at all-time lows. We just had a client get one at 1.39, and that's not uncommon right now. A lot of people are also aware that rental rates are down massively, anywhere from 5 to up to 25% in the downtown core. Now this ranges massively. If you're looking at a loft or a unique sort of boutique building, sort of outside of the core, that probably hasn't really seen much rental decline, if any. But if you're looking at a cookie cutter sort of investor, recently closed development in the downtown core, where they're most impacted by the lack of foreign students and the lack of immigration, those condos are hurting the most. You're seeing, rental declines in 20-30% even on some of the smaller studios and stuff like that. Now, before we get into all that, I just want to show you a quick example of a sold comparable. There are 2 units and 16 brokers. It's a building in Humber Bay, 2 identical units, a couple of floors apart, for a $62,000 difference across 3 weeks. So this unit, our first unit here, 16 brokers 805, it's sold on January 5th of this year for $515,000. They were listed for $519,900 and they sold with 22 days on market. Just gonna show you the photos here quickly so you get an idea of the finishes. It's a nice unit, a little bit of a water view. Now this unit 1005, is the exact same in every way. Has parking, has the exact same square footage. Okay, it's even the same down to finishes. The only difference is this unit doesn't have a built-in island. The previous one does. This one sold today with 8 registered offers. It was listed for $549,000. It sold for $577,000. So this unit sold for $62,000 more than the last one in just a 3-week spread here. Less than a month. So in less than a month, the price of this unit went up 10%, more than 10%. And this is what I've been trying to tell people who tell me they want to try and time the market, is that timing the market is a fool's errand. It is incredibly difficult to know when the dip is over. And the problem with trying to time the bottom is 99% of people miss out. The market shoots back up, and when the market turns, it turns on a dime. Just to show you the months of inventory here. Again, if you're new to my channel, months of inventory is just the number of listings on market divided by the number of sales. So if you have 2 months of inventory, that would mean you have 1,000 listings on the market, 500 sales, which means you have 2 months of supply. As you can see here, the bottom for the condo market was in September, October, and November of last year. That ship has sailed. Getting great deals has sailed. We are back in multiple offer bidding wars on any decent inventory downtown. We're at 1.7 months of inventory, an incredibly strong seller's market. And if you look through my past videos, this is what I've been saying. I've been saying that when the market turns, it turns quickly, and it's very difficult to time the bottom. In December, a lot of people told me that they thought the market was going to get worse in January and February as all those listings come back to market that had terminated and canceled in December. I told them they were wrong.
Not the kind of person to say I told us so. But you know what? I told us so.
Now moving on, I want to talk about how a 1% decrease in mortgage rate actually negates a 15% decline in rental rate. So this is these are theoretical numbers here, but these are actually based on a real unit that just closed. It's Scoop Condos, which is on St. Clair West near the Junction. Purchase price in both instances, we're going to say the same because obviously we haven't seen any appreciation in the last year. So your 20% down is $100,000. Now we're going to look at how the numbers change when your mortgage rate goes from 2.7 to 1.7. You can actually do better than 1.7 now, but just to keep numbers simple, we are going to go with this difference. So your mortgage, obviously your mortgage payment changes by about $200 a month with the decrease in 1%. On your mortgage rate, your maintenance fees, of course, don't change. Your taxes don't change. So this is your total difference. So in 2020, with the new mortgage rates, rough numbers, you're paying about $200 a month less for that unit. But we also know rental rate has crashed massively. So let's assume that you're in the middle of the pack. It may not be, the reality is the rents in the Junction aren't really down 15% from the buildings that I can see and the comps I've looked at, but just for argument's sake, let's say it is. So rental rate in 2019 might have been $2,000 a month, which was fair for a $500,000 unit. So you'd be negative cash flow $145 per month on that unit. In 2020, with the decrease in $300 a month, 15% on your rental income, you're looking at a heavier negative cash flow. So you're looking at $100 more negative cash flow per month. The thing I find people don't talk about enough when it comes to when it comes to mortgage rates decreasing is how much quicker you pay down your principal. So as I'm sure you're well aware, your monthly payment on your mortgage looks something like this. Every month you're paying a portion of principal and a portion of the interest. Now, what's great about low rates isn't just that you have a lower monthly payment in general, but it's also that more of that money is going towards principal and less to interest. Of course, as you get closer to the end of your term, you're paying more and more principal and less interest. But when you decrease your mortgage rate, your interest rate by 1%, your principal payment changes massively over the first year alone. So you look at this, and in 2019 at 2.7% mortgage rate, you would have paid about $8,800 down in your principal in year one. Now at 1.7%, you're going to pay down $10,320. So this year is your monthly principal pay down. And then we look at what I like to call a monthly net flow. You could call this your net worth increase, because you got to remember your cash flow might be negative by $244, but somebody is paying down the principal on your mortgage. So before you actually account for any appreciation in the market, you are making money on the back end of that. So your monthly net flow increase is actually more with less rent because of how the mortgage payment changes with the lower interest rates, because you're paying more principal and you're paying less interest. So your year one actually looks pretty identical in both scenarios. Of course, these are just theoretical numbers. This is based on a real unit. But I just wanted to show you guys how, because a lot of people talk about, low mortgage rates, and I don't think enough people kind of show you what that actually looks like when you account for principal recapture. It actually changes your investment in quite a considerable way, and just 1% on your mortgage can negate a 50% decline in rental rate. What you need to ask yourself is, well, we know that low rates are here to stay until at least 2023, or that's what the Bank of Canada says. Do you think rental rates are going to rebound quicker than mortgage rates? And I think the answer for that is probably a resounding yes. Obviously, if we use sales as a sort of leading indicator, we can see that we're in an extreme seller's market. So the idea of downtown being dead, of course, just isn't holding up. So that's it for this week, guys. If you have any questions, leave them in the comments below. Please subscribe and like this video, and I will see you on Tuesday.